All right, we're almost there. It's
Okay.
setting up your meeting now. Sorry for the delay.
That's
Okay,
all right.
thank you.
We had some technical difficulties. We had
We're getting used to that.
All right, we're live.
Okay.
All right, we will call the meeting of the Genesee County Employees Retirement System to order on Monday, the 17th of August, at 1:05 in the afternoon. Madam Clerk, will you take the roll, please?
Pardon me. Brandon,
Here.
Carpenter,
Here.
Quartz,
Here.
Seifert, Khan,
Here.
Mandalaris,
Here.
Simpson,
Here.
Young. Okay.
All right, any public address? Jennifer, do you know if we've gotten any communications?
We have not received any communications.
Okay, we will move on to communication items. I know there was one add-on this week with the work share program and how that'd be calculated. Jennifer, you want to take the ball?
Yes, so we had some questions come up about the work share program for Genesee County employees that were able to participate in that and how it related to their retirement benefits. So we're already giving them service credit for 40 hours, but the question was about compensation and whether that would have to be paid back or added toward their FAC. So I've directed Frank, I'd like to direct Frank, if it's okay with the board, to give a legal opinion on that, because when we were talking about it, I talked about it with Tracy and Debbie, and it seems like if we give them credit, it's going to really increase their FAC, and it's going to inflate it. So we really want to, I think, get an opinion on how we want to handle that, because this is a new scenario that we've never had before.
And it wasn't through the chair. It wasn't a huge dollar amount, but if you were just basing this on a person that earns $30 an hour, say, and if they were on a work share and given 4 hours per week that they were collecting the unemployment, getting 372. If they'd have been working, they'd have gotten 120. That's an additional 250 per week. Plus the $900 supplemental. Now you're talking $1,100 additional per week. So adding to that annual wage would be over $4,600.
Wow.
Yeah. Frank, what are your thoughts?
Yeah, so I think that we need to, dive deeper into it. I think the other scenarios where this has come up have been unemployment insurance, sick leave, vacation leave, FMLA, and we've really focused more on acknowledging someone receiving service credit for that time, not necessarily how we would include someone's or how it would affect someone's comp and final average comp in those scenarios. So I think my initial thought is if someone's still receiving the service credit, then I don't think we need to acknowledge the additional work share payment and the additional supplemental in their comp because they're already receiving the service credit for that time. It'd be like including someone's bonus or something like that, which I don't think is the intent of what the work share program is supposed to be. I think the intent is to bring them back up to their normal salary so that they don't have to do all this unemployment stuff but I think, like I said, when we've approached it before, the idea has been, okay, if someone's off for an extended period of time, how do we assure that they don't miss out on their service credit? But here, sort of an unintended consequence might be that they're going to artificially inflate their comp for final average comp purposes. And I don't think that's intended. So I want to look at the policy. I want to look at the definitions of comp. I know there's a letter of understanding for at least one bargaining unit about the work share program. I want to see if they address comp at all in there. I doubt it.
No, they didn't.
Yeah.
Yeah, we'll send that over.
So if they haven't, then it's probably, up to the interpretation of the Retirement Commission to decide, the best way to incorporate this situation. So, yeah, if someone, I think it's okay that Jennifer directs me to write that opinion. We've done that in the past. I mean, Tracy's asked me to write things, and, prior retirement office supervisors or retirement services administrators have asked me to, and we've done it without the board's sort of requests. So I'll take a look at that and have something for the, September 11th, I want to say. Whatever the September meeting is, I'll have something in writing, go over with the board, but hopefully I'll have something sooner for Jennifer. It's actually, I think it's the 14th, not the 11th. That'd be
Actually,
Friday.
I think it's the 21st because we changed it because of the MAPERS conference that got
Yep.
canceled. So we're on for the 21st of September.
Okay. Yep. So yeah, so I can address that at the meeting of the 21st, but I'll get Jennifer an answer before that for sure.
Thank you.
All right, thank you, Frank.
Okay.
And it's obviously going to be an issue with, we don't know how this is going to play out in the future with more bonuses or more compensation coming, maybe.
Right.
All right, thank you, sir.
welcome.
Moving on to agenda item A, approval of the minutes. Take a motion to approve A1.
I make a
Minutes
motion
of
to
July
approve the
6th.
minutes of July
Thank you,
6th.
Tracy.
Carpenter, second.
Got a motion and second. Any discussion? Any changes? Madam Clerk?
Brandon,
Yes.
Carpenter,
Yes.
Quartz,
Yes.
Khan,
Yes.
Mandelaris,
Yes.
Simpson.
Yes.
Okay, motion carried.
Thank you. Moving on to old business. Crystal's going to discuss some alternative investment issue, hopefully.
Yeah, so a question came up the last meeting. We talked a little bit about alternative investments with the auditors. I know there was some confusion over what all investments made up the amount that was included in their audit opinion. So it was 142 million. So I had Jennifer put together the schedule to show what investments are included in there. And the reason why these are all considered like level 3 is because Comerica gives us an estimate of the value. Typically, when we get them for the 12/31, they're using the most recent data, which may be as of September, when that investment did like a quarterly statement. And then when we get the audited financial statements, say it's a limited partnership, we look at either the shares that we're holding and what the footnote disclosure says our share is worth times the number of shares that we own, or if we own a percentage. So like for Bloomfield Capital, I use them as an example. What Comerica was reporting was about $4.2 million on the 12/31 statement. For our capital statement, we own 27.87% of that investment. So if we take our percentage and multiply it by their equity on their audited financial statements as of 12/31/19, we only own 3.4 million of the investment, which I rounded those numbers, but the difference is like 757,000. So that's why when we say it's harder to value, it's because we have to wait for those audited statements to be available. It doesn't necessarily mean it's not a liquid investment to where we're not, we may be getting cash payouts periodically because it's a very liquid investment, but when it comes to year end and we're trying to value it to include it in the Gcers audit, it's a little trickier to measure than a stock where we can go out onto yahoofinance.com, type in a ticker symbol, the date, and instantly you know how much that investment was worth at any given point in time. So that's why the auditors disclose that. It just lets the reader know that they're a little harder to value than the other level 1 or level 2. Level 1 is the ones that you can go to Yahoo Finance, type in some information, and instantly know what it's worth. Type 2 is kind of in a blend. And then type 3 would be these limited partnerships or real estate investments where we have to get additional data from a third party before we can effectively value that investment.
Okay. Any questions? None?
And like the auditors mentioned, you know, almost all pension systems have level 3 investments just because they typically have a higher return. So if you looked at any, let's say most pension systems, you would see that particular paragraph included. It's not a negative, it's just letting the reader know, hey, there's some stuff in this statement that's a little harder to value than other investments.
Okay, I believe Mark had the, they had the most questions on that, and they can go back and review on their own from here. Thank you, Crystal.
No problem.
Anyone else have any discussion on that issue? None. We'll move on to C1, new business, the investment report by Anco. Take it away, Chris.
Great, thank you. So I think I'm going to skip around a little bit, and
You may be able to share your screen, Chris.
Okay.
Do I have to stop sharing? Let me stop sharing if you want to. Do you want to share?
It's up to you, or I can just tell you which page to go to if that's easier.
Okay, we'll just do that.
Okay. So I'm going to have you start on slide 15, which might be, yes. And for those with a hard copy, this would be the page 1 in our report. And this is that quarterly recap. And what you're going to see is that we had some great results from the equity markets. So just as a refresher, and I know no one wants to kind of go back there, but if you remember, the first quarter started off on a good note, and then kind of late February, and then for most of March, you know, things got really ugly. Markets went down 30, 40, even more in the span of literally like 4 weeks. And then towards the end of March is when we started seeing kind of the government jump in and help out. And so, you know, first was the Federal Reserve, followed by the Treasury, and then Congress, all kind of putting together programs to help stabilize the markets and help weather the economic storm that was coming. And so as that occurred towards the end of March, that's when the market started kind of coming back. And it continued on throughout that whole the second quarter. And you can see the S&P was up just over 20%. Our small and mid-cap stocks did a little bit better. You can see the Russell mid-cap was up just over 24%, and that Russell 2000, those are your small cap stocks, were up just over 25%. The international markets also had a nice quarter, and you can see up, you know, kind of mid-teens. The emerging markets kind of being the best of the group. So not quite as good as we had here in the US, but still a really nice rebound. And then we even saw a nice we also saw really nice results in the fixed income markets.
Somebody's getting feedback. If you're not speaking, if you could all mute your lines. Jennifer, I could mute all if you like, but then folks will have to remember to unmute. Oh,
It's us.
that's good. It seems like we got it. I don't hear the feedback anymore. Sorry about that, folks.
Yep. So as I was saying, the fixed income markets also had a pretty nice quarter. You can see that's that Bloomberg Barclays US Ag, and it was up about 3%. And I will tell you it was also up in the first quarter a similar amount. And really what we saw in fixed income was the first quarter, it was interest rates going basically to zero, and then treasuries doing really well. And then in the second quarter, it was corporate bonds coming back. And if you look at the bottom, that Bloomberg Barclays corporate IG, you can see it was up 9%. Corporate bonds had a really difficult first quarter and were negative, to the tune of 5 or 6%, and then had this nice rebound of 9% in the second quarter, and really drove kind of the performance of the fixed income indexes. So as I said, all told, it was a great quarter for stocks and bonds. If we look at the table at the bottom of this page, we then, look at the full year. And I think the big surprise here is if you look at that S&P 500, you'll note that it was up 7.5% over the past 12 months. So kind of given everything that we've went through in, the first quarter, to think that, the equity market actually ended up in positive territory with a decent return, I think is pretty outstanding. I will point out though, if you look at the Russell Midcap, that Russell 2000, and all of the international indexes, they're all still in negative territory. And we've seen kind of a common theme in, I would say, the past 2 years of every time we take a step back in the markets, we see that, the large cap stocks in the US, so that S&P 500, they don't fall quite as much as the small caps or the international markets. And then when we get the rebound, they're able to kind of get back into positive territory, where oftentimes that mid cap, small cap, and the international markets aren't able to kind of climb out of the hole that they fell into during the drawdown. So, there's a big difference between kind of large cap US and kind of the rest of the world in terms of stocks over the past 12 months. And then kind of the big surprise I would tell you is, in fixed income, an 8.7% return from core fixed income over the last 12 months. I will point out, it was about a year ago when the Federal Reserve had just started stepping in and saying, we're not raising rates anymore. And in fact, we're going to start cutting rates. And obviously that got accelerated in that first quarter of 2020. So, a decent period over the last 12 months, but everything outside of kind of large cap and core fixed income actually detracted from performance. Any questions, kind of market related? All right. So slide 18 has the snapshot of your asset allocation at quarter end. And the one note I would have here is you'll note the international equity was slightly above our target weight. So we have a target of 18 with a max of 20. We had just crossed over the 20 at 20.5. And we'll be using WCM in coming months for liquidity to bring that back in line. That's the one manager who has kind of outpaced everyone and kind of pushed that allocation a little outside of our guidelines. If we go ahead, 21. Yep. This is the recap for the quarter. And just wanted to point out, we started the quarter $405 million or so. We had contributions of just under 7. But we also had withdrawals of about 13, so kind of net negative 6 million. And then if you look under income and appreciation, you'll note we had about almost $3 million in income and over $30 million in appreciation. So we actually had a pretty nice recovery. You can see 432, almost 33 million at June 30th. So as I said, made back a lot of the losses that we had suffered during that first quarter. And the bulk of that is coming from your equity investments. So the domestic equity and the international equity account for almost 90% of that, if not more. And skipping ahead a couple more, it would be slide 23 as your performance for the quarter. And so we had I would say, a decent quarter. You can see the fund was up over 8%. And, when we looked at it in terms of dollars, we were talking almost $30 million. I will point out, we did a little bit better than our policy index, which was about 7.5%. But if we look at our peer group ranking, we're towards the bottom of that. And I'll talk about that a little bit more. The average public fund was up about 12 and some change. So you can see all public funds was 12.2, and then public funds under $1 billion was about 12.7. And as I said, we came up, I would say, well short of them. If we look over the year to date, kind of a similar story, out in front of our policy index, but a little bit behind our peers in the public fund universe. And it isn't until we kind of hit the 3 and 5 year mark where we kind of pull ahead of the average public fund. So I mentioned one of the, I'm not sure I want to use the word detractors, but one of the managers that didn't kind of keep pace with the rest of the market was that low vol strategy. And I know we've had conversations about that, for quite some time. If you look at the low vol strategy, it was up, 6.7%. And if you remember, the S&P was up over 20. And in fact, if you look at that bottom line there under that WHAM S&P 500 low vol, it says IM US large cap core. Those are how kind of active managers performed during the quarter. And you can see they were up about 20. So we did not kind of keep pace with the market. A large part of that was we did not have exposure to some of the more volatile names, some of which kind of were up and down in that, were down sharply in the first quarter and then rebounded very sharply in the second. And a lot of them are also kind of some of those growth names that suffered, that just did very, very well, but their volatility kind of keeps them outside of our strategy. And so if you look at the year-to-date number on that, you can see we're down about 13%. The average manager in that space is down about 4%. And what we saw was, we came down in the first quarter with the market. We captured about 90% of that fall in the market, but then we only captured like a third of the kind of rebound in the second quarter. And that then also hurts your 1 year number. You can see the 1 year number is a -7. Remember the S&P was positive about 7.5. It starts getting a lot better when we look a little bit longer. The 3 and the 5 year numbers kind of put you closer to the middle of the pack in the peer group. I will point out, so I've spent quite a bit of time taking a look at this low vol strategy and saying, what happened, kind of what went wrong. I will tell you, it almost seems like it was a perfect storm for it to underperform, just kind of given the whipsaw that the market did and kind of the names in the strategy versus the names in the benchmark. The benchmark is actually getting quite concentrated. So you've probably heard the term like FANG stocks. That's the Facebook and Alphabet, Netflix, Google, and Amazon. And now they're, I think, throwing Microsoft into that kind of as well. We really don't have a whole lot of exposure to those names in the low vol strategy. And what you're seeing is the S&P 500, those handful of names are representing almost 20% of the benchmark. So, a handful of, you think an S&P 500 being a very diversified benchmark or strategy, at this point, it's really concentrated in a handful of really kind of tech-oriented names. And, we do think at some point we're going to see some reversion away from, these handful of names and kind of into the broader market, which I think will help out with the low vol strategy kind of performing more in line. I also think if we see, a regular pullback in the market, I think the low vol strategy continues to work. And, in this pandemic situation where people all of a sudden went, lived and worked from home, and all of a sudden, they're using a lot more tech, we didn't have the exposure there. And then the other area where we didn't have a ton of exposure was healthcare. That was the other sector that did really well. I don't think that, the next crisis is going to look like this one, where those same type of sectors are going to have the excess performance, and that some of the sectors that we did have kind of more exposure in, will kind of underperform by as much. So as I said, I think, if we look over the last 6 months, it was, as I said, kind of that perfect storm for the strategy, but I don't think it's broken at this point. we continue to take a closer look at it and see if there's anything we can do to see if there's a better mousetrap in that space. But we haven't come up with anything at this point. Any questions on that one? As I said, that one strategy was responsible for, I would say, the bulk of the fund's kind of underperformance to peers. No?
Hey, Chris.
Yes.
Hey, Chris, I just have a quick question. I mean, do you see the low volatility fund still performing good for us? I mean, I'm just looking at like the 10-year and stuff like that across the large cap. And it seems like we'd be almost, I mean, it seems like we're always underperforming to everything else.
You know, so you've underperformed. Like if you go out to that since inception, you can see you're up about 9.2, 9.1 roughly. The average manager is up about 10. I will point those are all kind of done gross of fees, and we're paying a fraction of the price that the typical active manager would charge you. So it's probably more like 10.1 versus, excuse me, 9.1 versus kind of like a 9.5 if you were to kind of go net to net. And I will tell you, you know, there's times where that low vol strategy really kind of pays off. So it does historically smooth out your return pattern, meaning that when the market goes down 15, maybe you're only down 8 or 9 or 10. But when the market's up 20, maybe you're only up 15. That I would say is a more traditional kind of performance cycle for the low vol. Not this, you know, the market's down 20 and we're down 18, and then the market's up, you know, 20 and we're only up 6. That is not what I would say is kind of the traditional performance for the strategy. As I said, we continue to look at it, and this is, you know, the intention is to have an IC meeting coming up here probably in the next month, and this was one of the I thought we'd take a look at the overall asset allocation as well as the manager structure, just to make sure we're all comfortable with where we're at. So we'll kind of revisit this at the IC meeting here probably in September.
Thanks.
Yep. Any other questions? Just the BlackRock strategy performed right in line with expectations and continues to do a fine job kind of giving us, you know, mid-cap exposure. And then Earnest had, I would say, a really nice quarter. On the value side, you can see up 20, just right ahead of their benchmark by a couple basis points. But if you look at their year-to-date number, much better, you know, still negative, down 14, but their benchmark actually was down 22. Kind of a similar kind of difference there in the 1-year number. And then you can see at the 3-year number, they're actually in positive territory and up into the 13th percentile. As I said, they've done a really, really nice job in that small value space. That's been very, very challenging. On the international side, you know, First Eagle and WCM, I will tell you, had both nice quarters. It should not be a huge surprise to you that First Eagle underperformed this quarter. You know, this is a very defensive strategy, kind of like the low vol. You can see it was up 11, the benchmark was up 16. And then the WCM strategy, you can see is a growth-oriented strategy, kind of, you know, where the tailwind has been. And you can see there we're up 25. And what I really like is that combination of the two. So we have what I would say is a very defensive strategy, as well as a, I don't want to call it super aggressive, but, you know, a growth focused strategy. And, you know, when we look at the combined results between the two, it looks very favorable. If you look at the 1-year number, you'll see First Eagle, top half of their universe. You look at WCM, you know, up into the top 10% of their universe, and, you know, both of them outperforming nicely. And you can see that, you know, the since inception numbers for both managers show quite a bit of excess performance. So, you know, I would say we have a great team in that space. Towards the bottom of the page, we have the fixed income managers, Mackay and Sit. Mackay had the more difficult first quarter and had a nice rebound this quarter. Sid had a better first quarter and, not quite a strong second quarter. Both managers have done a nice job, though. If you look out at their 3-year number, both of them are ahead of their benchmark and, kind of providing very nice exposure to that intermediate fixed income space. If we flip ahead one more page, we have the real estate managers. PRESA 1, you can see is negative. PRESA 3 was slightly positive. And I know we've talked about this in the past, those negatives that we're seeing in real estate, we think there's going to probably be some continuation there. The real estate market tends to be a lagging indicator, which means it takes them a while to factor in what's going on into their asset prices. And so it's not uncommon for, 2 or 3 months, or 2 or 3 quarters after a crisis that they continue to have write-downs. And so particularly at this point, obviously hospitality, like hotels, have seen a decline in value. Retail, and that includes both kind of the malls, which I think most people are familiar with, but even some of the shopping centers are seeing some stress in their valuations, just as the TJ Maxx's or something like that had to be shut down for quite some time, and they're not quite seeing the foot traffic that they used to. So as I said, some of those strip malls that are in these portfolios have seen some pressure. And then lastly, office. And that's kind of the big unknown. Now, office tends to have a little bit longer leases, think 5-10 years. And so a lot of that hasn't really repriced at this point. But there's a lot of question about how much office space is going to be in demand and where at in the coming years, as more and more people have kind of figured out how to work from home. And, in years prior, usually like the best office space in the downtown was like the most desirable. So think like Manhattan or LA or San Francisco. There is some thought that people don't want to jump on a subway to get to work anymore. And that, the downtown location, which is maybe problematic for transportation, may not be as desirable as kind of some of the suburban office space. So, if you're thinking of like the San Francisco, maybe all of a sudden now it's, out in Oakland or Palo Alto or wherever, people might be looking at those as more desirable spaces based on where their workforce actually lives and wants to commute to and from. So that's something we're watching. As I said, PRESA 3, recall, is a little bit more aggressive and does more kind of the rehabbing. We actually think this time period probably works well for that type of strategy. And I think if you go one more page, we have some of the alternatives, half of which have priced, half of which have not, or maybe it's more than half have not. So do want to point out Bloomfield 2 continues to have some pressure. I've been talking with them quite a bit. The hope is to have that wound up by the end of the year. I would not hold my breath on that one. There are still a handful of properties in there, and a couple of them I think are going to take a little bit longer than that. Bloomfield 5 is performing very well, about 5% year to date, and almost 10% for the 1 year. All right, let's see. The other ones are all kind of real estate oriented, and I think they're all performing pretty well at this point. The good news is a couple of them, like the JCR 4, Alidade 4, I think we're looking at some opportunity in those to perform well going forward. Obviously, the Alidade year to date, there's been a little bit of a struggle with a property being written down there. Any questions there?
I got a question about the. Is it going to be open-ended?
Hang on just one second. I think we're somehow.
We got some echoing on the line. Let me go ahead and mute all, and then you'll have to unmute when you want to speak. Okay, so I've muted everyone on the line. If you would like to speak, if you could unmute your line. I just wanted to get rid of that background noise.
Did you have a question, Jennifer?
Jennifer, you'll have to unmute on Zoom. I muted everyone to get rid of the echo. Oh.
It sounded like Bill Brandon had a question, but I don't know what happened.
Yeah. Can you hear us now?
Yep, we can hear you.
We're using the conference room phone, so we have to stay muted on Zoom.
Okay. Yeah, you guys are the ones with the background noise.
Right.
Disregard my question.
Feel free to ask offline. How's that?
Or you can type it into the chat.
Okay, so I just muted them again because of all the feedback.
Jennifer, we could jump ahead to 54. I know we usually don't look at these pages in the report, but I pulled out this one in particular. This is Allidaid Fund 2. So this was the fund that actually just wrapped up earlier this year. We received like our final distribution. If you could just scroll down a little bit. Yeah, perfect. So what this is showing you is like the performance of that strategy. And what you'll see is that we ended up committing like $9.5 million. So we actually committed just over 10, but they ended up, just based on the way the money was called, it turned out to be 9.5. And then they distributed $18 million back to us. And so you can see when we calculate a performance for them, the inception IRR, meaning like what was our return on each dollar we invested over the course of this life, turned out to be 19.438, I rounded up to 4. That would be equivalent to an annualized return over, this 8-year period of 19%, just over 19%. So that's actually a really, really nice return. We have a couple other statistics here. That TVPI, that's the total value to paid in, and then the DPI is distributions to paid in. What this is saying is for every dollar we put into Allidaid 2, we received $1.77 back. So that's the other kind of way. The IRRs sometimes are a little bit misleading just because they take into account the time that you were invested. So if you were invested for a very short period of time, you can have a really high IRR, but not actually get a whole bunch of extra dollars back. When we look at the two combined, that's where you can kind of make sense of like, did this really work out for us? And so having that 1.7, I would say, is a very attractive total value to paid in. And the other measure, that direct alpha, is a way of comparing. If we had just put this into a public real estate investment, we would have done like 7% worse. So, think of that 19% that we got, subtract 7 from it. What this is saying is that the public market probably would have given us about a 12, but because we used Allidaid 2, we ended up with 19. That makes sense to everyone? So as I chose this one because this one will be going away. I'll probably leave it in the report for the rest of the year, and then after that we'll take it out just because it's no longer active. But I did want to kind of walk everyone through some of the numbers in the back of the report. And I would tell you, when we have what I would say a mature fund, something that probably has 5 years with it, then all of a sudden those numbers are meaningful. If you look at some of the newer ones where you only have a year or two, the numbers kind of get a little bit goofy. If you have one good quarter, it looks like you're doing incredibly well. You have one bad quarter, and it looks like it was the worst investment ever. You need to be able to kind of settle those out over a little bit longer period of time. I'm going to jump way back to the front and go to page 10. Jennifer, you want to put page 10 up?
Jennifer, can you hear us? We need to be on page 10.
So page 10 is going to show the July performance. And I just wanted to point out, July was another good month in the market.
Chris, I'm sorry, you lost Bill and I. What page are you on? We just had to get reconnected.
Oh, I'm sorry. On page 10.
10, thank you. Thanks, Sherry. Okay.
Perfect. So this
We're back online.
Yeah, this is the July market, and it was another good month. You're going to see that the S&P was up another 5.6%, and you can see year to date it's actually in positive territory. Russell 2000, your small cap stocks, not quite as good. You can see a 2.7% return there. Year to date, they're still down 10.5%. And if you look at fixed income, another positive month there, up about 1.5%. And once again, driven by those investment grade bonds, just like we saw in the second quarter. I did want to draw your attention. If you look at those colored boxes over on the right side and look at the year-to-date section, what you're going to see is that Russell 1000 growth, that is the LG box, it's the dark green one, is up 18% year-to-date. If you look at LV, that's one of the orange colored boxes. You can see that's down 13% year to date. So we were talking about this when I was talking about the low vol strategy a little bit, that those FANG stocks or those growth oriented stocks are up 18% this year, but the value counterparts in large cap are actually down 13%. And that dispersion between the two, I will tell you, is very, very wide on a historical perspective. So when we look back at other periods of time and say, when growth does well and, how does value do? Oftentimes growth would be up 20 and value might only be up 10. Like a 10% dispersion, we would say is a pretty wide for a 6-month period or so. For it to be like negative, like 30%, like where we're at now, that's extremely wide. That, that's like that 3 standard deviation event that you hear people talk about in statistics. And you can see if you look at the prior year, 2019, right next to it, similar story. Here, I would say is a little bit more rational in that, growth is up 36 and value is up only 26. That's that 10% spread that I would say, you would say, yeah, you could see why some stocks do better than others. And there's, some momentum in the market, or vice versa. It could easily be the other way with value doing better than growth. But when you look at what's happened so far in 2020, it makes you kind of scratch your head and say, at some point we should see some reversion here, and those large value stocks should do better than the large growth stocks. And I think that would really benefit our low vol strategy as well. And if you want to move ahead one more page, I have updated market values. So if you remember, we ended the quarter about 330 some million. You can see we crossed over, 430, I think it was 33 million. We're up about another $7 million through the first couple days in August. And really a bunch of that has to do with, once again, those equity markets going up that 5% or so that we saw. So, all our allocations are pretty close. If you remember at the last report, we looked at that WCM I mentioned will be kind of on target for future cash flows. You can see we're still just over that 20% threshold. And that's with a couple stale market values in there for First Eagle and WCM. The July market values weren't quite available when we put this together. I happen to know that WCM actually had a really nice July as well. And so we'll be looking at taking some money away from them in the fourth quarter for liquidity for benefit payments. So I think with that, and that concludes my report. I'd be happy to answer any questions.
Anybody? I think I answered my own question, Chris. I'll follow up with you in email.
Okay.
If no one has any questions, we'll take a motion to accept.
Move to accept the report.
Thank you, Ms. Courts. Get a support.
You may be muted.
Sorry, yes,
Anybody?
I was muted. I second.
All right. Thank you, Tracy. Any discussion? Madam Clerk?
Carpenter, I think people forgot they were muted. Yeah.
Yeah. Well, you have to unmute if you'd like to speak. I had muted
Support.
everyone.
Carpenter.
Okay.
Thank you.
Quartz,
Yes. Yes.
Khan,
Yes.
Mandalaris, Mandalaris. Is he muted?
Yeah.
I can't tell. There's several phone numbers. So I'm not sure which number would be his. I can just ask everyone to unmute and it'll pop up a message on their screen.
Am I unmuted now?
Yes.
There you go.
Mandalaris, can you hear me?
Okay. Yes.
Yes, sir.
All right, okay.
Okay. Simpson,
Yes.
Brandon.
Yes.
Okay, motion carried.
Motion carried. Thank you. Moving on to C2, approval of the proposed election schedule as amended.
So the clerk's office asked that we change the ballot processing. It was the week of Thanksgiving, and with the other election going on, they thought they would get more help if we moved it ahead a week.
Anyone opposed to moving ahead? If not, I'll take a motion to amend it as read.
Motion
I'll make that
to
motion,
amend
Mandalaris.
Mandalaris, supported by Tracy. Any discussion? All in, Madam Clerk?
Okay, Quartz,
Yes.
Khan,
Yes.
Mandalaris,
Yes.
Simpson,
Yes.
Brandon,
Yes.
Carpenter.
Yes.
Okay, motion carried.
Thank you. Moving on to C4, scheduled deceased retirees.
I
Take a
think
motion.
Mr. Brandon, I'm sorry, I think we skipped past 3.
We certainly did. Schedule
Okay.
of the billing expenses. My apologies.
Motion to
Entertain the
approve.
same motion. Thank you, Tracy.
Support.
Thank you, Jeff. Any discussion? Ms. Clerk?
Khan,
Yes.
Mandelaris,
Yes.
Simpson,
Yes.
Brandon,
Yes.
Carpenter,
Yes.
Quartz.
Yes.
Motion carried.
Thank you. Now on to C4, schedule of deceased retirees.
Motion to
I'll make
accept
a
the
motion to
receipt.
approve. Support, Mandelaris.
I'll take Tracy and John. Any discussion? Madam Clerk?
Khan,
Yes.
Mandelaris,
Yes.
Simpson,
Yes.
Brandon,
Yes.
Carpenter,
Yes.
Quartz.
Yes.
Motion carried.
And C5, schedule of new retirees.
Motion to approve the schedule of new retirees.
Thank you, Tracy.
Support.
Thank you, Jeff. Any discussion? Madam Clerk?
Mandelaris,
Yes.
Simpson,
Yes.
Brandon,
Yes.
Carpenter,
Yes.
Quartz,
Yes.
Khan.
Yes.
Okay, motion carried.
Thank you. The C6, schedule of reemployed retirees. Doesn't appear that anybody's on the list here. Entertain a motion?
Motion to
Make a
approve.
motion to approve.
Thank you, Tracy, seconded by Carpenter. Any discussion? Madam Clerk?
Simpson,
Yes.
Brandon,
Yes.
Carpenter,
Yes.
Quartz,
Yes.
Khan,
Yes.
Mandelaris.
Yes.
Okay, motion carried.
Moving on to C7, adopt the updated election policy procedures. Looks like just some wording changes.
Yeah, so with this one, we no longer have to coordinate with the IT department, and it just said office supervisor versus retirement services administrator. And then down on H, a question came up last year during the election as to whether or not deferred people were allowed to sign the petition. So we just wanted to add that in there, that they're not allowed to sign the petition.
Are deferred people allowed to run for the office?
No.
No? Okay. All right. We'll entertain a motion?
Motion to adopt,
Make
Mandelaris.
motion. Support, Carpenter.
Mandelaris and Carpenter, any discussion? None. Madam Clerk?
Simpson,
Yes.
Brandon,
Yes.
Carpenter,
Yes.
Quartz,
Yes.
Khan,
Yes.
Mandelaris.
Yes.
Motion carried.
Thank you. Moving on to the legal report, C8, from Mr. Judd.
He may still be muted.
There we
You
go.
with us.
Better? All right, I'm here.
You're not going to mute him.
No! Very important person here. All right, so C8A is an email that we received last year from Faruqi and Faruqi, just explaining that they were no longer going to provide services for portfolio monitoring. At that point in time, we had 3 groups that were doing monitoring for you for securities litigation. You had Faruqi, you had Labaton, and we added Robbins Geller maybe like a year and a half before this. think the question came up, well, we had 3 before, well, we had 2, then we had 3, and now we're down to 2. Do we want to add a third again? Is there any benefit to that? Sort of what does the board think? So we wanted to just reopen that for everybody's thought and discussion. Our office is not recommending anyone. We think you get plenty of coverage from David at Labaton and Robbins Geller. David frequently participates in your meetings, either through, he shows up a couple times a year, maybe in person, or lately he's been on your Zoom calls. I think our office has been very pleased with them and is also very positive with Robbins Geller. But if the board does want to add someone, I'm sure we could find another firm interested. But like I said, we just wanted to put that back out there on the agenda and see if anybody had any thoughts or concerns or opinion on it.
Does anybody have any interest in adding a third or just moving forward as is? What's the board's pleasure? Frank, I think we're going to agree with you.
I agree with Frank that Robbins Geller and Labaton seem to be the 2 that took the most action. We get good coverage with those 2.
Okay. All right, thank you. Well, let's move on to the reports then. So your first one is from Labaton. David, I don't believe is here today, so I'll handle this one. Probably the only pertinent part of this report anybody's interested in is the appeal on the Is the Fix case. If you recall, they have that one random claimant, Fortinbras, who's claiming that the process did not work to their satisfaction and that their proofs of claim were rejected improperly. They filed their appeal brief, and now David's group has until October 1st to file their brief in response. So that's another 6 weeks or so. Once that happens, Fortinbras typically has the ability to do a reply brief. So they would be able to respond to anything that Labaton brings up in their brief. They probably have a shorter amount of time for that. So maybe it'd be like November or something. And then the court would hopefully have a decision by the end of the year or the beginning of next year. I know this one's sort of taken a long while, but it is a big case. I'm sure they're taking their time appropriately with it. I know the Robbins Geller report did not get here in time to be included in the agenda packet that was sent out before. Oh, yeah, there it is.
Yeah, I emailed it after.
Oh, okay. All right.
Everyone.
Yep. I knew you emailed it to me. I didn't know if you sent it to everybody.
Yes,
thanks,
I sent
Jennifer.
it to the board.
Okay.
Yep.
Going through here, there are no new cases recommended by Robbins Geller. So there's no action to be taken on either one of those. So the only items that I'll bring up from my office's perspective, we've been continuing to update you guys on legislative updates, including Governor Whitmer's executive orders. She has now sort of combined her remote meeting orders with just the general state of emergency order. So as she extends the state of emergency, she's extending permission to meet remotely like this. And now instead of setting an end date on the remote meetings, it's now linked to whenever the state of emergency ends, plus 28 days. Well, the last time I looked at this was a week ago for you guys. And the state of emergency is scheduled to end on September 4th, which would extend everybody meeting remotely until October 2nd. It wouldn't surprise me in the least if she continues to extend the state of emergency. But I guess we'll wait and see. And I know it's coming up in a couple, probably the next item here as an informational item, but the MAPERS conference for the fall was canceled. I've consistently said we're cautiously optimistic about it continuing, but it will not happen. There will still be a business meeting, which is scheduled for that September 14th date that we previously talked about when I thought this meeting was scheduled for. So I think you can probably watch that sort of like this, either YouTube or Zoom, and sign in if you want to as a Genesee County trustee and delegate or something or other. But yeah, so those are the only updates that I have for you. I will work on that opinion on the work share comp FAC issue and get that to Jennifer. Hopefully it'll be a quick turnaround, and we'll talk about it next month.
All right, looking forward to it, sir. If anyone else has anything to add, if not, we'll entertain a motion to adjourn.
Motion to
How about
adjourn.
accepting the report? Accept the
I'd like to
report.
make a motion to support Frank's report.
Absolutely, we should accept his report before we adjourn for the day.
Thank you.
Yeah, I got a question too.
Go ahead, John.
No, not really with, with respect to the report, but how are we handling the minutes for the non-meeting of August the 10th?
I believe it's just going to be a one-liner that says, due to technical difficulties, it was reassigned to today's date.
If that's okay with Frank, that's fine with me.
Yes, I think that makes the most sense.
Okay, Deanna, you'll
Okay.
prepare that and send
Yes.
it over?
Yes, I
Thank
will.
you.
Real
right.
quick, sorry to interrupt, Mr. Brandon, I got support, a motion by Carpenter, but I didn't hear a support.
I believe John was in
I'll
support
support it.
of
Oh,
accepting.
okay.
I'll be sorry.
Thank you.
If you want to take the roll on that vote?
Yes, I will. Brandon,
Yes.
Carpenter,
Yes.
Quartz,
Yes.
Khan,
Yes.
Mandalaris,
Yes.
Simpson.
Yes.
Okay, motion carried.
All right, thank you. Now, if Chair will entertain a motion to adjourn.
Move
So
to
moved.
I'll
adjourn.
make that motion, Mandalaris.
Support
Mandelaris
Carpenter.
and Carpenter. Ms. Clerk?
Carpenter,
Yes.
Quartz,
Yes.
Khan,
Yes.
Mandalaris,
Yes.
Simpson,
Yes.
Brandon.
Yes, ma'am. Thank you, everybody,
motion
and
carried.
hopefully we'll all see each other in end of September. Thank you.
Yep.
All right,
Thank you.
thanks, everybody.
day.
Have a good day.
Okay.
Stay safe.
All right. Bye now. Bye.